Welcome to another Glenbrook podcast. And it's a first today. It was a first last time as well, in the sense of we had our first international podcast with Dr. Richard Barkham. And this is the first podcast where we've returned to get an update and have another chat with somebody. I was privileged. It was the date was pretty important. And please go back and have another listen to it. It was the 19th of May, 2020. We were in lockdown. Richard was in lockdown. And we had a really strange but good conversation. And please go back and have a listen first. So pause the podcast now and have a listen to the 19th of May podcast 2020 with Richard. Richard, it was called The Global View. And come back and listen to this because you'll be far better informed following on with what we're going to chat about. But Richard's a very special friend, very old friend. I first met Richard when I was 18. He was a lecturer of mine at Reading University and then became a colleague or a neighbour in Grosvenor Street when I worked at Grosvenor. He was at CBRE or Hillier Parker, and then came in to Grosvenor as the title is probably going to be wrong, but head economist at Grosvenor, and then took an amazing job back at CBRE. And his titles now, he's got various titles, very important. Global Chief Economist, Global Head of Research, and Head of Americas Research. Is that right, Dr. Barkham?
That is correct, yes.
So we're going to have a follow-on chat today from the 19th of May, 2020. I'm going to talk a bit about what happened after that podcast because Richard was living in Boston. I'm not going to tell you where he is at the moment. He'll tell us in a moment, but he was living in Boston, Massachusetts. And there's a lot of water under the bridge. We're going to talk about the world when we last spoke, where the world is now. We're going to have an American view on things. We're going to look about the future, the next few years, what's happened in Q2 this year in the economy. We're going to talk a bit about multifamily. We had a really interesting insight in 2020 about multifamily, and we're going to talk about that and just have a little chat about life generally. And I want to hear at the end, if you listen to the previous one, you'll know whether Richard is still sailing around in his yacht. So that's the general chat today. So hello, Richard.
Hello, Guy. I'm delighted to be here. I can't believe it's 4 years or so since we last spoke on this podcast. And that May 2020, that I think that wasn't the worst month of my professional career, but I think that was April. And we do these podcasts, we got into Zoom technology. We were just getting into it then, and we were doing all manner of podcasts. But I think the one that we did in April 2020 was about the most stressful because not only was the world apparently falling apart due to the impact of COVID and particularly the lockdowns, but I think in April the oil price went negative as well. So that it just we had to we had to go and be constructive with the situation. It was very stressful.
We were chatting. You were in your bedroom, ironically, or your office, home office. I was in my bedroom. The sound was much better from you, ironically, given that you were the other side of the world, across the Atlantic. Your sound was amazing. Mine was really muffled in my bedroom. And it was a good chat, but I got the feeling there was nerves from both of us, really.
Yeah. Well, I mean, of course, we were in the height of lockdown then, and we were still trying to make sense of all of the, where it's going to go. And of course, we were looking at the trajectory of the COVID disease, and then we were going back and looking at the trajectory of other similar diseases. And as it actually happened, once you sort of grasped where the disease was going, and you looked at the kind of the trajectories, you could see a way through this. I mean, it was going to, we were conscious that, we were probably looking at 1 year or 2 year of very disrupted economic activity, but we would be able to get through that. So we had that disease trajectory that we sort of fastened onto. But then I think the other thing that I as an economist saw coming, people were looking at the disease, but I was looking at just the amount of government stimulus that was going to go into the economy. And I was saying to myself, COVID or no COVID, this is just humongous. This is a Second World War level of stimulus. So, I quite quickly came to the view that um, probably the economy was going to revive quicker than people thought, and so it did.
But our experience was that when we spoke in May 2020, our world had fallen off the edge of a cliff almost. Very concerned about what was going to happen. No one was in the office. And then we started another build to rent family, multifamily scheme in Salford Keys, Media City in Manchester in the middle of 2020, which was incredible to be able to let a contract and start on site when everybody was locked up. It was quite difficult. And then 2021 was a phenomenal year. We had numerous transactions which made significant returns to our investors. And then 22 was really good as well. And then really it fell off the edge of a cliff at the end of 22, with various things happening domestically here.
Yes, I mean, I think you've sketched out the trajectory very well. We had that huge stimulus, which included super low interest rates. So they're just the and it this is the biggest, I mean, literally the biggest economic stimulus since the Second World War. And, just not just in the UK, but in the America, in the developed world. And of course, it really propelled economic activity. But you know what the consequences of that were. You have a big boost to demand at a time when the COVID disease has attenuated the supply side of the economy. So you got a supply shock, negative supply shock, a positive, demand boost. And so what do you get? You get price rises. And it spurred, from about the middle of 2022 until around now, just, inflation. And, central banks took a time to react to that, but they had to jack up interest rates. And of course, that particularly after a period of low interest rates, and you've got all the leverage in the system, caused the transactional side of the market to the investment transactions just to collapse.
Well, Liz Truss took a lot of the blame, and she was put up there on a pedestal to take a lot of the blame almost in this country, because that was happening elsewhere without Truss economics happening. But I think she was used as a person to put the blame on, because effectively the same thing happened around September, start of Q4 22. That's when it all started to fall apart, wasn't it?
Yes, I mean, I think we would have probably had the more or less the same trajectory of the economy, with all that kind of Truss episode. Um, so it was a global thing. A lot of people in the United States tried to blame President Biden for the inflation.
Mm.
Um, well, to be sure, he was very supportive of the stimulus, and he would have wanted to do more. But this was a global phenomenon. And you've got to remember, back to 2020, we did not know where the world was going. It was an error in the end, I think, of putting so much stimulus into the economy, but it was a forgivable error.
Mm.
Um, we
It's
we just
yeah.
didn't know where the world was going, and we had to put money in to support the economy. And as it turned out, the economy revived, a little bit quicker than people expected, and inflation took off. And
It
then,
was like being a parent for the first time, actually, in a way, because running a business at that point was like being a parent, because there's no real rules. You got to make it up as you go along, and you're not going to be prepared for what you had to encounter running a business and having people in a team to work with. And I go back to May 2020. It was great having the chat, because we were doing things that sort of resembled a bit of normality, but we had so many teams on teams meetings with our colleagues that it was just trying to get some normality back into the day-to-day life.
yeah, that's right. And I think it's only now that we're beginning to sort of see through. It's 4 years on, and some normality is coming back into the economic environment, into daily life. But there's
So
always
you would,
there's always some other turbulence. These periods of kind of peace and prosperity are yeah, they're kind of relatively rare.
so you were sat in your house on the waterfront in Boston watching the odd jogger run up and down the waterfront, if I recall. You were set a very nice scene, and there was nobody in the office. Um, I'm looking out the window at that lush grass outside, and looks like Wimbledon to me. Are you back in the UK, or where are you now?
So at the end of 2020, I moved to Dallas. So CBRE's HQ is Dallas, and I moved to to the HQ to be part of the HQ team. A lot of the other functional heads are located in one or other of the CBRE hubs, but this is the HQ. So I moved to Dallas, and what you're looking at is the kind of office environment in what we call it the uptown area, but it's really the central area of Dallas. And that lush green is just astroturf on the top of the building, and you've got an office complex and a residential complex. Somebody asked me the other day if I had a chicken coop out the back, but it isn't. It's a residential complex, and that's where people take their dogs for their morning and afternoon conversation with
So
nature.
how big is the Dallas CBRE HQ, as in people?
As in people, it's not that big. 200 to 300 people.
Okay.
We've got some senior finance here, senior strategy, or some executives here. The finance function is quite large, and of course,
Why?
actually, it's the Dallas office itself is here too, and the Dallas CBRE is this is one of the biggest, most rapidly growing parts of the world. So, the ordinary brokerage business is quite big here.
Really? Okay. I'm fascinated. But back to Boston very briefly. So you'd been in Boston. When did you arrive in Boston?
2017,
So you
and I
did
left.
5 years.
Yeah, I did 5 years in Boston. I'm coming up for 2 years in Dallas.
And does that mean being in Dallas you do less traveling? Because last time we spoke, that was another thing that came out in the podcast, is that you talked about travel, how everybody was, you know, gluttons for punishment when it came to traveling around the America and the world. And one of the things you were hoping that would come out of COVID is that people traveled less and did more of this. But has that manifested itself?
I think it has. I did an analysis of my diary for some other purpose,
Yeah.
and that 2019, I was on the road 4 days out of 5, mainly traveling in the States. Um, I would say now I'd be traveling 4 days out of 10. So
Okay. Considerably less.
and that's the impact of modern communications, Zoom technology and video conferencing and all the rest of it. It's just I can get more done by staying here and interacting remotely. Now, obviously, you do have to travel, and but ultimately no substitute for face-to-face contact. If you've got really serious high-level work to do, or you want to make a presentation to clients. But yes, the travel has gone down. Although you wouldn't believe it from the sort of passenger statistics on US airlines, they're just as robust as they were. But we very much as a corporation have tried to bear down on cost in this area of travel.
And not being in Boston and being in Dallas, personally and business wise, how has that changed your life?
Well, it's a very interesting question. I mean, it's taken a while for Dallas to grow on me, but it's certainly visually not a very attractive place. It's a big, sprawling city. But I can tell you, you won't like this, and the figures are kind of approximate. But probably when I left the UK, I'd pay about 46% tax.
Yep.
When I got to Boston, it was 38%. Now I'm in Dallas, it's 33%.
Right.
So it kind of colors the way you look at things. And the economic growth here, there's a whole set of factors. And you've probably heard of the red states and the blue states and the populations moving here. There's a whole bunch of things going on in the case of Texas. One of which I think is relatively light regulation, and relatively light land use regulation. But the economic growth and dynamism is just incredible. And it's a friendly place, and the food is good, and the one of the big surprises to me, just the countryside outside Dallas is very attractive,
That's really interesting.
very very pretty.
You wouldn't expect it, and physically. One more question before we get to talk about work. Moving from Boston to Dallas, how long did one hell of a drive for the removals company, isn't it?
It is, but that I just you just put all your stuff, you give it to a removals company, and they do a very good job. And then, sort of 3 weeks later, it appears in your apartment in Dallas. It was very easy to move. That's one thing Americans do very well is mobility. Uh,
Yes.
all the process of changing your address and it's just very slick and easy to move around the place, in America.
So let's talk about where we are now. So, we had that chat in 2020. We've just summarized where the world has come on that journey. I've been out over in Leeds this morning with some investors looking at a large site to get funding, and it's pretty doomy and gloomy. And I think we've done very well because we don't have any debt in the business, and that's stood us in good stead. I think we'd be a lot more worried if we had debt. But talk about where we are this year and what you're seeing, especially over in the States. What are you seeing about how the economy's changed just coming into this year?
Well, I think the big and good news is that the largely COVID-induced inflation, is trending down. I mean, I don't think all of the inflation is COVID or supply shock induced. Some of it is demand side. We've got very low levels of unemployment in Europe and the United States, so it's quite easy for wage growth to creep up and feed into prices. But I would say, by and large, inflation is trending in the right direction towards the target levels that central banks, the Bank of England, the Fed, the ECB, are comfortable with, and that means interest rates will be able to fall. You've already had the ECB cut, and you've had the Bank of Canada cut. I think we're expecting a cut in the Fed funds rate in September. Um, I don't think we're going back to a world, pre-COVID of, 0 or 1% interest rates. The world has changed since then, politically as well as economically. But the good news is that I think financial conditions are going to be easing over the next 18 months. And I think also in the case of Europe, it's a bit less so in the United States. The fall in inflation, is allowing consumers to be able to spend more. So you see a little bit of a consumer-led recovery taking place in Europe, and I would say you've got the same, development in the United Kingdom. Um, I think we'll probably see, you know, uh, based on our current forecasts, a reasonably good year in 2025 of not blistering growth, a little bit subpar growth, but with inflation and interest rates coming down, I think that will be generally a good picture. Now the other thing to take note of course, is this has been a year of elections. You've had your election. We've got another election coming up in the United States. And so far, not too much impact on policy, but I think new governments around the world, we might see some policy shifts coming up, which we'll have to try and figure out. So that's a little bit of the uncertainty as we go into 2025. But the economics based on falling inflation and reviving consumer spending, and relatively robust consumer spending in the States, are looking okay at this point. And of course, I think, as interest rates come down, we in real estate will be, interested in sort of the revival in transaction activity and the firming up of values. I think that's in prospect as well. A gentle recovery in real estate capital markets activity, probably quite a robust recovery in Europe, in capital markets activity over the course of 2025.
Well, that's what I was going to actually talk about then, was that I think it's interesting because what happened at the end of 22, everybody realizing about inflation and interest rates and so on. There's been a very slow lag from those changes or those things happening. So people were still investing and doing deals into 23, early 23, and there was quite a lag. And so we funded some deals, well into 23, in fact, towards the end of 23. But actually, this year has been just seen pretty much a halt on everything, certainly as far as we are concerned. And I think that that's quite interesting because there will be a lag coming back out the other side as well, because investors generally are quite lemming-like in terms of following the leader, even though the fundamentals might be there and you might be giving your clients reason to believe positive things. People don't like being the first mover, do they?
No, they don't. I mean, I look at this as a sort of economist. The capital market cycle is what we call a sawtooth cycle. It's always a slow build up, and then it's an accelerator at the end, and then a collapse. It's like a sawtooth. Now we're at the early stages. And I think, investors are looking at three things, of course, when they make their decisions. One is the cost of capital. The other is the kind of fundamentals. Are they stable or are they in decline? And the other is just the kind of the risk that, or the alternatives that are out there.
That's,
And
that's what we're seeing a lot. The alternative gilts are very interesting.
Well, of course they are. That's right. And if you look at the government, that's the government deficits around the world, particularly in the United States. There's a lot of new issue. There's a lot of government debt out there, and it's not exactly 5%, but you can get 5% on fairly secure investments, and so all of the stars have to align, but. There is a lot of capital out there queued up, waiting to go. And I think it'll probably, in Europe, be a reasonable, a reasonably robust recovery. But I take your point, and my point is, it's we're at the start of a new real estate cycle, and it's usually a slow start.
Yeah, and it's very challenging for us as a smaller business because we don't it's not in our nature to turn the tap off on investing in things, work in progress. So we're working at projects all the time, have numerous multifamily sites being worked up, but then I called it a sausage machine, in that you're putting all the meat into a hopper, but the sausages weren't coming out the other side, so we're just chucking more and more meat into the hopper and there's nothing coming out. And I think that analogy is how we feel at the moment. And you've got to keep the faith and keep investing in your sites, because the funding will come.
I think that's right. I think if we come and do this podcast again in 4 years' time, I think we'll be looking back at 2024 and 2025 as real vintage opportunities to invest. We've got some residual nervousness about interest rates. So as you say, the rates are high, and opportunities to invest elsewhere in risk-free assets are actually quite attractive. But I think in terms of the value drops that we've seen in global real estate, this is absolutely a good time to deploy capital. And I think investors will be seeing that as well. So it is a good time. You get the best bargains in the most distressed times.
I agree, and we are very careful at the moment because investors are very careful, and it's a challenging time. But I think it's one that's gonna look back and say,
But
we'll kick ourselves for buying things, I'm sure.
Yeah, and with it's been odd because unemployment is very very low. I mean, levels of employment has been comfortable for people, but jobs are been relatively abundant. And that I think is usually pretty supportive of housing markets. And anything that is real estate and consumer spending linked is probably the fundamentals are reasonably good. Um, you know, ma-
So one of the things I was keen to just touch upon, we did last time, was talk about some of the sectors. So I've written down three notes. Multifamily. I want to chat about multifamily. I'll summarize where we were. Beds and sheds is a term that they use a lot in the UK, and I want to talk about that because that's been the darling of the last 5 years. Probably less so the last year or two, but certainly the 3 or 4 years before that, absolutely the darlings of the market in the UK. And talk about retail. I'm quite interested in retail. So let's just start at multifamily. When we spoke last time, you gave us a bit of a masterclass about multifamily, in the US, and I enjoyed that because I think there's a couple of classes and that people were buying tired multifamily schemes from 20 years ago and refurbishing them, and they were being reinvented and getting significantly good returns from those. What's happened over the last, well, since 2020 in multifamily in the States?
well, I think there was a period when 2022 when interest rates started going up, where if you look at the market as kind of the demand and supply components, you've got completions and you've got net absorption, where net absorption really dropped in 2022 for a couple of quarters, but in 2023 it came roaring back as people. The US economy. I'm going to speak about the US. I'm more. I know it very well. US, economy is extremely resilient to higher interest rates. And once people had worked that out, they came, pouring back into the apartment market. Um, but I think all of those economic stimulus measures that I mentioned earlier, the government stimulus, the low interest rates, had also kicked off a real supply surge, a real construction boom in multifamily. So from about mid 22, sort of from about 2020, early 23, we were delivering per quarter about 100,000 units in the United States, and absorbing maybe 80,000 of those. So, there's been a little bit of an increase in vacancy rate, but not very much. By and large, sort of multifamily, because of the robust employment market, has been rental growth has come right down, but quite solid fundamentals, I would say. Um,
Did COVID, with multifamily, certainly in the UK, people talked about balconies, open space being much more desired in build to rent schemes in the UK. Is that what changes have we seen in the last few years in, if you're aware of any, in the States with regard to build to rent?
I don't, I don't think there's been much change really in the style of it. The multifamily sector is a very mature sector in the States, and it's very well established, and it's very well. It's a US success story. Pardon me for sounding a bit kind of American chauvinist here, but it is. It's very well managed, and you have different kind of design, different kind of construction for different segments of the market, and different locations. So and there's a lot of different types of multifamily or apartment property or build to rent property, whatever you want to call it, developed. Um, but
We,
you can see out, probably see out the back,
yeah.
um, but I think the big complexes, in the US, they would tend to have quite a lot of common space. My apartment block's got a swimming pool, an outdoor deck. It's got very nice gym, lots of, kind of reception space where you can host parties, and most sort of multifamily would be designed with quite a lot of common areas. I think there is a focus on creating community as part of the management of the completed asset in the States, which is what I noticed more than any sort of design shifts.
We've seen the same in the sense of, I think it's gone to peak a few years ago, it went peak open space, shared spaces, facilities. And I think people have rode back quite a bit from that with regard to just the sheer cost of running those and the leakage from the rent that's coming in. So I think people have gone mass market probably and realized that it's not very helpful to have those facilities, and they weren't being priced into the rent particularly well in the UK. So I'd say that the mass, and I think the economy has probably dictated that a little bit as well, and that it's the mass market, middle market, where you've got the most customers, and there's a bit of an affordability crisis there as well, I suspect.
Mm. I think for the viability in the long term, you've got to keep faith with the common areas, and making these places livable. You and I know that from our time at Grosvenor. Running high-end residential in London. There's still a lot of emphasis on provision of an infrastructure that makes it nice to live there. Managing the retail offer, and urban public space. And that was there in the kind of Mayfair and Belgravia, going back to the very beginning. But you have to have urban amenities. Even if they cost you, they pay off in the longer term in terms of the viability and the long term capital value that you can get from those assets.
I was liking this morning with our investor that managing build to rent multifamily is a bit like shopping centres in a funny way, in that the asset management element is huge and really important. In that, I think some people think you just get a property manager in to do the lettings and do the management of the shared spaces and so on and so forth. But actually, they're really important to manage them strategically in terms of rent and growth, and there's an asset management role that's really important. If you don't have that, then they can lead a life of their own a little bit, some of these buildings and communities, and you don't get the performance compared to other schemes.
No, you've got to work very hard, and it's behind the scenes always. I've got a lecture on this. I call it dynamic stability. It's like, in order to keep the assets stable and healthy and vibrant, you've got to work really hard behind the scenes to create livability and facilities and amenity.
Beds and sheds. So we've seen, beds. There's still a really strong market in the UK, but it's paused or it's slowed down. But there's plenty of money, but it's just pausing at the moment. Sheds fell off a cliff about 18 months ago, and some people paid very top prices for land, which are looking like an embarrassment now to a certain extent. And build costs obviously have gone up, but not as much as residential. But shed build costs are looking expensive, and there's been a calming down of demand. Has that reflected itself in the States as well?
I mean, let's look at the kind of the occupier side. We had, along with part of the COVID, shift to shopping online, really, created a boom in occupier desire for kind of for industrial property. Of course it did. We know all about that. And since I think 2022, the amount of gross leasing that we've done has come down and come down. But it's about at its long run average now. It's gone back to a normal level of gross leasing. And of course, the COVID, it's just like multifamily. The COVID stimulus really created a huge construction wave in the industrial sector. So we're absorbing over the course of 24, 25 about 500 million square feet of space. And with gross leasing falling down and net absorption being somewhat weaker than it was, vacancy rates have gone up, but they've only really gone up, I think, to the kind of long-term levels. Of course, so I would say the fundamentals are actually quite healthy. Getting back to a normal level of supply and demand. There haven't been, as in multifamily, as in office, as in retail, there haven't been very many investment transactions for the last 18 months, as the investment market has adjusted to a higher cost of capital. So depends what you mean dropped off a cliff. Certainly investment transactions and values are down, I would say. Values are down 20, 25%. Cap rates out 150, 200, 300 basis points.
When I say dropping off a cliff, what it means is that nothing is viable to deliver on a development basis because it's dropped 25%.
Well, I don't think that would be quite as true in the United States. The supply of land is quite different, and companies will have big land banks. But I think we are, and I think up until fairly recently, there's been quite a good level of new starts, but new starts are dropping pretty quickly now, as vacancy goes up. But I don't know it's to do with viability. In the States, it's 500 million square feet is hitting the market, and I think people are just waiting to see, that will, how all that will be absorbed. But I think by 2025, most of that, will have been absorbed. And my buddies in the States, tell me that sort of 80% of the stock in the States was built before 1980. So, there still will be and we're seeing in the States the growth of what we call 3PLs, third-party logistics companies. So companies doing less of their logistics and more outsourcing of logistics. And these guys are really professional, and they're really, they're bringing in just a whole new professionalism to logistics. And they'll want to operate out of the better quality stock, the newer quality stock. So I think out of that, there'll still be, a decent level of absorption available for developers. So I think probably new starts will pick up, as I say, over the course of this year and into 2025.
I think the shock happened much sooner here. Actually, interestingly, listening to you there, I think I'd say it was early 23 really that things slowed down, and it's been really quite profound how things have changed. So it's still a very healthy part of the property market, but it's just not as much has happened in the last 12 to 18 months because of just build costs, and land prices have gone down, and it's just become very difficult to deliver industrial.
Yeah, as I say, I think to summarise, we're absorbing a big supply surge in the States, and of course, as consumer spending comes down, and what we've seen is a balance. During COVID, everybody was just sitting at home buying Peloton bikes, and maybe just kind of stuff. As the economy has come out of COVID, people are buying less stuff and spending more time in kind of restaurants and spending more money on services. So the demand side, but we still see, I think, globally, the penetration of e-commerce into retail sales, continuing to grow, and therefore that's going to feed through into demand for modern industrial and logistics facilities. So probably that market will come back, reasonably robustly and reasonably quickly.
And build cost inflation, I mean, it applies to beds and sheds, but we've seen massive inflation here, and things probably tailed off and stabilized in the last 12 months, but it's the uncertainty. No one really knows where build costs are going. What's happened over with you?
I mean, yeah, we've had the same, huge cost inflation. I think, it's slowed down to, from sort of 7 or 8, possibly even, cost inflation in the teens, down to stable 3 or 4% cost inflation. Um, but with these really tight labour markets, and very high levels of employment, it's very hard to see those build costs. They won't go to zero, and they won't. But I think there's some evidence that they're falling back a little bit in the States, as commercial construction activity in multifamily and industrial has eased back. There is some evidence of falling cost, but not very much and not very convincing. And of course, President Biden has been stimulating construction. We've had what we call the CHIPS and the IRA Act. There's a lot of money going into the construction of manufacturing plants in the States as well.
We've had, of course, post Grenfell, there's been significant fire regulation changes. We've had a lot of environmental changes. And I think what's happening with inflation, build cost inflation, even if it has tailed off, all of those being replaced. So now with the Building Safety Act, there's a 3-month lag at the start of development project where plans effectively get reviewed by the building safety regulator, and it adds another 2 months as well, particularly at the end. So it's causing mega issues. So any savings we're going to have, or any reduction in pricing, is being mopped up by regulatory changes.
Yes, now I can see that, and what does society need most? It needs more housing. We're probably 3 to 4 million units short of single family housing in the United States, which is why the apartment sector has been so strong. But one way or another, with the best kind of motivations, regulations come in and make it more difficult to supply the market with housing. I see that. You've explained it in the UK, but it's true everywhere else, particularly in the States.
Retail. So you and I first, now from university, but at Grosvenor, we spent, and actually you said on your podcast about Liverpool One and how much you enjoyed your involvement and engagement with Liverpool One. And actually, I didn't, when you went there last, probably haven't been there for many, many years, but it's still going really strong in terms of a destination. We are quite interested in retail again at the moment because actually the fundamentals are there. The pricing is very, very attractive and very good. The question is, you can buy a good investment. It's about exit, I think, is the one question, because the way pension funds invest their money is changing a bit in the UK, and buying high street shops probably isn't the top of their list anymore. What does the retail landscape look like, both on a consumer side and then on a property side, real estate side?
I mean, so consumer spending, goes along with unemployment. If unemployment goes up, consumer spending drops, and unemployment is very low. It's trending up a little in the States, but not much. So consumer spending has been robust and resilient. Some signs that it's reacting to higher interest rates, but it's pretty robust at the moment. And I think the retail sector in the States is the most interesting of all. Very attractive at the moment, and probably the strongest fundamentals. And it's slightly different story to the UK, but you will see some parallels. We haven't built any retail in the United States for 15 years, so there's no new supply to absorb. And my brokers are telling me that they can't do deals. There's just not enough Grade A space out there. On the other hand, if you're an investor and you're thinking, oh, well, that sounds great, big supply and demand imbalance, it is true, but you can't necessarily push the rents in the retail sector either, because what we're finding is that, you talk to retailers, and it's not like talking to retailers of 20, 30 years ago. These guys, not hell for leather expansion on any kind of whim. They know their business. They know their catchment areas backwards, forwards, and sideways. They know if they locate in this area, they can make this amount of money and they can pay this amount of rent, and that's all they're going to pay. So retailers are much more sophisticated than they used to be, which is good because they're much more solid tenants. But it's just not that easy to push the rents as it was. And I would say in the case of America, I think a lot of retailers were quite a little bit old-fashioned and quite highly geared prior to COVID. But they all kind of went out of business during COVID and filed for bankruptcy. But were able to restructure their balance sheets, close down their shops that weren't working for them, and have come back with much stronger balance sheets. And they've all also, I think, particularly over COVID, but it was happening, but it's really accelerated. They've all got very slick omni-channel kind of business models now. So they can play both. They can play the e-commerce and the bricks. So retailers are better. There's not much retail space, and consumer spending is slowing but strong. In the States, it all adds up to a very, it's a very it's a good place to be, retail at the moment. And I do see institutional capital coming back into the retail sector. It's been, for the last sort of 5 or 6 or 7 years, it's been dominated by private capital. But I think institutional capital is coming back in, looking at, they've seen all of these things. And you're not going to make huge, it's not going to be, these are not outsized returns, but they're good, solid assets. That serve a community, serve a need. I mean, I think in the States, you probably find in the UK, the grade B and C malls, they're still struggling a bit. But I noticed around Dallas, it's quite interesting. You go to what was obviously, quite a well-constructed mall, has been repurposed as a kind, and what would have been sort of clothing and footwear, is all taken by antique stores or children's playgrounds. So malls are kind of, B and C malls are probably still struggling in some cases. In other cases, they're kind of being repurposed for a whole range of activities. And they make for, I don't suppose they pay really top rents, but most of the space is let. And they provide a service and to the community, and there is some revival in, as I say, B and C malls are struggling, but being reinvented in certain cases with unusual kind of uses.
Well, I don't know if you remember Mike Ashley of Sports Direct, of Sports Soccer, has bought up brand after brand after brand. He bought Fraser Group, House of Fraser, and Flannels, and they were all tenants of ours in Liverpool One. And basically, his next plan is buying up shopping malls, shopping centres, and filling it full of his brands, and being the anchor and having 5 fascias, which are all coming under the House of Fraser, or the Fraser Group branding. So he's his own both tenant and landlord in his own building, buying them from pinch and trading his socks off. So there's an interesting new concept. This has happened numerous times now, and I think it's really interesting how he's clever enough to have spotted there's a niche or an opportunity in the market, and he's filling his own tenants in his own properties.
Well, as I say, the malls, the B and C malls have struggled, but eventually, with a degree of economic growth, they're not coming back as they previously were, but there is opportunity to repurpose them. Particularly, when they're not being built anymore. And they're often quite well located as well, with good car parking, or at least in the States. So,
I think the Starbucks thing is interesting. I was going to ask about F&B, food and beverage, and we've seen the rise and fall of Starbucks here, I reckon, in the UK, in that Starbucks opened numerous outlets in each city, and certainly in Manchester Liverpool, I can observe that they've closed a lot of those outlets and haven't replaced them. And they've gone and opened a lot out on retail parks or in services or standalone drive-throughs. But actually, food and beverage is really strong at the moment in terms of high-end nighttime economy food and beverage. But the daytime Starbucks are just being out competed effectively on rents in the market.
Hmm. Well, I would say my observation is, particularly since COVID, I've not been able. Starbucks has been booming in the States. Wherever I go, for Starbucks, I always have to queue. It's been remarkable. Both the standalone or the drive-through, or even the in-town facilities, always hugely busy. And it's not just people sitting around, using the free Wi-Fi. It's long queues for coffee.
Yeah.
But more broadly, I think that was the real story of the 2009-2019 period. There was a boom in food and beverage, which absolutely got hammered by COVID, and it has come roaring back. Absolutely roaring back. And you're seeing it in, if I look at the economic statistics, you see very elevated rates of new firm formation in the United States. Very high performance businesses, and half of them are new restaurants. So yes, food and beverage is back really strongly, booming.
So I was going to touch upon your day job a little bit, in that when we spoke last time, you're quite heavily in demand from clients around the States, traveling, going, meeting them, giving them an insight into what's going on. You manage a huge team. You're top of the tree for several hundred staff across globally, effectively. What are clients asking you at the moment? What's really interesting that clients are asking you? And I've written down wild cards in my notes. And what I meant by that is, what's fast approaching us that we don't see from the back that we should be aware of? Is there anything interesting that, whilst you haven't got any foundation for it, you think is quite interesting we should have a chat about?
Yes. Well, look, I think for the last 18 months or so, the inflation thing has been, front of mind for clients, and they're still, there's still, it's really scarred people. And we stopped studying inflation like 40 years ago when Mrs. Thatcher came in. Inflation, we didn't have to worry about it. So everybody's forgotten about inflation. And so we've all had to go back and relearn everything to do with inflation, figure out every last, a potential cost push, demand pull, different drivers of inflation. So, when I go out and talk to clients now, I've got 10 slides on analyzing inflation and why it's probably going to come down. And then, of course, that, for real estate clients, that relates to the second question is, when's the 10-year Treasury coming down? The absolute crucial variable. We've had 10 years of 10-year Treasury at about 1.9, and now it's at 4.2, and it has been as high as 5. So that's the absolute benchmark in the States. So, we have to, take a view on when the 10-year Treasury is coming down. And I think, we would. And it's true, because if you look at the UK 10-year Treasury, that follows the US Treasury. So, and that's the base for cost of capital and financing in this. So it's the same sort of equation, but it's what everybody asks. We do think that the 10-year is trending down, maybe to 4% at the end of this year, to 3.8 at the end of next year, and maybe 3.5, 3.4 the year after that. So we're not going back to the 1.9%, but it's behind that. It's not just an inflation story though, and it is I think government finances. I think the thing that I'm talking about, which people are sort of half listening to, is just the size of the US budget deficit. Given that we've got reasonably good economic growth, and reasonably good tax coming in, there should be a time when the government deficit is kind of is shrinking, or maybe even possibly becoming positive, or it hasn't been positive since the 1990s in the United States. But it's still depending on how you look at it, it's 5 or 6%, and the US is an outlier. And we've got an election on in the United States, and I take a constructive out. Whoever it is, Kamala Harris, Donald Trump, they're good guys. They're wanting to do the best for America. They just see the world from a different place. Um, but nobody's really talking about how they're going to deal with the budget deficit. So, we might be looking, I think, longer term at some kind of bond market volatility, and that has a spillover negative impact in the real estate market. Would be one thing that I would be looking at. The other thing, of course, and you'll have seen it in Europe, and it's probably coming more in the United States, is increasing usage of tariffs and disruption of global supply chains.
Okay, that's really interesting.
So you've had the EU putting tariffs on Chinese electric vehicles,
Now, that's what exactly that thing I was going to say.
and you've got ex-President Trump talking about a 10% tariff on all goods into the United States. So I think longer term, I mean, the global economy is incredibly flexible and can react to lots of different political changes. And I don't think politics really has that much impact. But, you asked me to say things that we don't think about much and ought to just, pay a bit more attention to. I would look at the changing nature of global trade. Hasn't had much impact at the moment. Actual global trade is not disrupted too much, but I would say using tariffs to protect domestic manufacturing, could have some knock-on effects that might be worth thinking about.
Your point about electric cars from China is really interesting, because it was Goodwood Festival of Speed last week over in the UK, and it basically it was the rise of the Chinese car manufacturers. It was all about Chinese names, and everybody's been chatting and said it's interesting that the domestic manufacturers weren't present, but China had taken over the event basically.
Well, I think there's we've already had a little bit of a trade war with China. I think there's potentially looming more trade war, because China's economy is struggling. It's got a very collapsed housing market, and if the housing market's weak, it's difficult to get consumption to be strong. So China is really looking at its exports to generate growth, and I don't know that with the political changes that governments are going to tolerate cheap goods from China. So I think that's a potential disruption. I mean, I don't. Most policymakers will know that too much disruption is bad for everybody. But that's one area that I would be looking at.
Time is flying away. Actually, I just looked at my watch. Half an hour has gone on since when I last looked at it, so I must have been enjoying it. So we were just talking about clients and things you learn from those. In terms of how many clients do you have in your portfolio? Do you have to report regularly to 40 clients or 5 clients, or how much in demand are you from that side of things?
I mean, I do collect statistics on it, but they escape me. I would probably be doing something like 200 plus, bespoke client presentations every year. And we've got our top 25 clients that I'm always available to, but there are, outside the big investment houses, the big corporations, there are lots of regional businesses in the States that I provide presentations to. And I just I do my best to look at the economic data, and of course, being CBRE, we've got brilliant in-house real estate data. So I just try and combine. This is where I think the economy's going, and this is what it means for the different sectors. And some people will be interested in multi, some in industrial.
So wrapping up, last time you spoke, more fun things. Moving on to more fun things and what you do in your own spare time. So your life will have changed quite a bit since you moved from Boston because you're a big fan of the wide open seas, aren't you, and sailing. So talk to me about that. What happened to your boat?
Well, I had to leave that behind, Guy, in Boston. I did get 5 days sailing in this year. A very nice cruise out of Boston down to through the Cape Cod Canal, through Buzzards Bay, across the Martha's Vineyard. Fabulous, fabulous. Could have been wind could have been a little better, but no, you have to find new things to do in Dallas. There isn't. In fact, it's not strictly true. Dallas has got many huge man-made lakes, which they use for
Okay.
water supply. So if you want to do boating, and there are plenty of yachts, there's plenty of availability. I think the Lake Texoma, which is just north of Dallas, is one of the US's biggest man-made lakes, and there are plenty of ways you can sail, but it just never quite once you've sailed Massachusetts Bay, or once you've sailed, once you've done it doesn't quite seem the same thing. So you have to find other things to do, really. And it's strange as it may seem, Dallas has got great, great cultural facilities. The arts are great, the concerts are great, the food is great, the art galleries are great. So, and there are 2 or 3 months in the year where you just have to stay indoors. It's 40 degrees out there.
It's
Um,
serious.
oh yeah.
So what is it? What's it now? It doesn't, because it doesn't look sunny. I presume it's overcast out there.
No, I think it's a cooler 30 degrees today.
We're
But
about 18, I would have thought. Yeah, something like that. I would have thought we're about 18 degrees here. 23. We're 23 at the moment in Manchester.
okay, well, I'm at probably 29 degrees here. So you have to find different things to do.
Great.
Um,
Well, I'm very grateful yet again for you giving up your time, and it's been really good fun chat and hearing about things. You get my mind working like I used to back at Reading University, because it's certainly something I don't think about enough. We take the micro view, so much as a business, hands-on business, and it's good to think about it more globally. Really.
Well, that's my function basically. I deal with a lot of people who take a micro view, and you have to when you're doing real estate. But I come in and give the macro, give them something to think about of the broader business environment. Anyway, it's been a real pleasure to catch up with you again, Guy. Good luck with everything.
Really good fun. Thank you so much for giving it your time. And perhaps in 4 years' time, if not before, I can return and maybe I'll pop out to Dallas and see you in person.
Oh, you should. If you want to understand America, you've got to come to Texas. It's well worth seeing.
I'd love that. Well, thank you very much. And I look forward to the next one.
See ya.
See you. Bye.